Good morning, ladies and gentlemen. In today's part 2 of the Wyckoff series, we'll briefly be discussing Wyckoff's 3 laws: the law of supply and demand, the law of effort versus results, and the law of cause and effect. We'll predominantly be spending our time discussing Wyckoff's trading schematics, or as I like to call it, the Wyckoff Trading Zone. All right, let's jump right in, guys. So Wyckoff's 3 laws are pretty basic. The first law is the law of supply and demand. When demand is greater than supply, price rises. When demand is less than supply, price drops. When demand is equal to supply, there is no significant price change. But this is usually an indication that there is either an accumulation or a distribution phase. Wyckoff's second law, the law of cause and effect, states that the difference between supply and demand are not random. Rather, they're an intentional effort of the composite man to manipulate the price either through accumulating assets or distributing assets. Wyckoff's third and final law, the law of effort and result, discusses the correlation between asset prices, or their result, and their effort, which is represented by the trading volume. So if result and effort are going hand in hand, for example, price is increasing and the volume is also increasing, this is a strong indicator that the price will continue in the current trend. Although if we notice a divergence, for example, price goes up and volume's going down, this is an indicator that the trend is weakening and that we're seeing the distribution of the asset rather than the accumulation. Now that we have a foundation set below us with our understanding of the Wyckoff fundamental laws and the composite man, including his actions and motivations, we can step into the Wyckoff trading channel. In this example, we have a downward trend which is beginning to reach the end of the rally. This is first indicated by the preliminary support that we reach. This is when bulls start entering into the market and buying up assets. We might notice some pullbacks here and some sideways movement, but it's not enough to end the rally completely. Eventually we'll head down and we'll reach what is known as the selling climax. This is when the sellers have exhausted all their momentum, and due to the excessive supply in the market now, there's a massive automatic rally from the buyers absorbing this supply. This range here, established by the selling climax and the automatic rally, creates what is known as the Wyckoff Trading Zone. Once a trading range has been established by the selling climax and the automatic rally, we enter into Phase B. Phase B is based off Wyckoff's law of cause and effect. This is the consolidation stage in which the composite man accumulates the highest number of assets possible. During this stage, we'll also witness what are known as secondary tests. This is the time in which the composite man tests the selling climax to ensure that the bears are out of steam and that the bulls are in control of the market. During this time, we'll also see lower lows, which serve the purpose as bull traps to cause the average trader to panic and sell off their assets to the composite man at lower prices. Once the composite man has accumulated enough supply, we enter into Phase C. Phase C is known as the Wyckoff Spring. Wyckoff Spring is the final attempt of the composite man to ensure that there is little to no supply left in the market and that the bulls are in control. The spring often heads down and breaks the support level in order to stop out traders and mislead investors. This is an attempt of the composite man for one final time to buy shares at a lower price before he marks up the phase. The spring is often identified by a break of the support, but not always, with a rise up and then what is known as the cocking mechanism, a slight downward trend which triggers the spring to be released up into Phase D of the cycle, where we begin to see last points of support. These are when the market begins to make higher lows, each testing as previous support until eventually we hit the sign of strength, where the previous resistance of the trading range now becomes a support as the market begins to oscillate within its region. Once the sign of strength holds and the resistance becomes a support, we enter into the final stage of the accumulation cycle. The composite man has accumulated enough supply, and it is evident by the breakout of the trading range, caused by the increase on the market demand. This is when the trading range is effectively broken and the uptrend begins and the markup phase of the composite man starts. Let's look at a live example. Here I have Intel Corporation pulled up on the chart, and we'll notice here in phase A, we have exactly what we're looking for, a massive rally that started going down. But if we look carefully around here in the $28 mark, we started noticing that the bears are losing control and the bulls are starting to enter into the market, which is indicated by this sideways movement and the up and down of the market. But it's still not enough to end the downward market. Until we get down here around the $14 market, we reach the selling climax. Once we reach the selling climax, the sellers are exhausted and there's an excess supply within the market. This causes the bulls to enter into the market and purchase up, facilitating the automatic rally. So now we have a selling climax and we have an automatic rally. This creates the trading zone for the Wyckoff channel and transitions us into phase B. Phase B is where the composite man now is starting to accumulate supply. Look how supply is starting to go up. Volume is going up within this area here. We're seeing a huge amount of volume increase within this trading range. Once the composite man has accumulated enough supply and we've had attempts at secondary tests, even though they didn't go past the selling climax, they still tried to do tests. The market was very strong. We came up to the final phase of phase C of the Wyckoff spring. Now we've noticed the spring here. We can see the spring in action. The composite man is attempting to scare out all the final traders within the market and investors and confuse them. Bring the price back down one more time to the low to support, even go a little bit lower, and then we cock the spring, buy up all these suckers that sold, and we start launching up. Now we enter into phase D, where we start seeing last points of support. The market is beginning to start testing these support levels, and then we get to the top of the resistance level and we start seeing signals of strength. The market starts testing this area. We get up here, and now we notice at this point right here, this resistance has officially become support as the market is starting to bounce off of it, which takes us into the final phase, phase E, when we mark up the cycle. If you notice here, this is over a fairly long period. This is from 2001 to 2019. Although this is an effective example that we're seeing here, the Wyckoff channel exists even on smaller time frames. If we look at areas around here, we can see even subtle fractals of the Wyckoff chain existing. Just keep in mind that the smaller time frame you are, the less reliable it is, and the more chaotic it will be. So go around, look at a couple different charts, and see if you can spot some of these Wyckoff trading zones and potentially enter into a trade and make some money. Hey guys. Hope you had fun and enjoyed the video. If you found it of value, help me out and hit that like and subscribe button. If you want to follow me on my other social media sites, check me out on Twitter and Instagram at Matt McGlay. Link in the description.